This is the first half of Chapter 11, in which we will discuss the characteristics of a corporation, the advantages and disadvantages of a corporation, the difference between common stock and preferred stock, and the accounting for stock transactions. We can divide entities into separate categories. First one is classified by purpose. Not-for-profit, like the Red Cross, the American Cancer Society. For-profit, Starbucks, McDonald's, Coca-Cola. Then they can be classified by ownership, publicly held, which will be true for McDonald's, Nike, PepsiCo, Google, Coca-Cola, and Starbucks. Privately held, one company that comes to mind is Koch Industries. It was a company that I worked for many years ago, and of course, if you've listened to the news, you've heard the talk about the Tea Party and the Koch brothers. That company is a multi-billion-dollar company, and they do not release any financials. What we have here on this slide is a list of advantages and disadvantages of incorporation, and it would make more sense to put these in two separate slides, but for whatever reason the publisher does not. So we're going to, with each subsequent slide, we're going to go through each one individually. Right, so it says here the first one, characteristic of a corporation, is a separate legal, it has a separate legal existence. So it's a separate legal entity or an artificial person. It can be taxed, it can be sued, and it can engage in transactions, so that the corporation acts in its own name rather than in the name of the owners or the shareholders. Limited liability. The stockholders, they have limited liability in terms of, in the event that a company is sued or is liquidated, the most that a stockholder can lose is their investment in the corporation. They cannot lose any of their personal assets. Another advantage is the ease of transfer of ownership rights. So therefore, on the secondary market, shareholders can easily sell their stock and other investors can buy the stock. Because corporations typically are very large, and if they have access to the equity market, they are able to raise large amounts of capital funds through the issuance of stock. An organization, as long as it is well managed, has continuance as a going concern, and is not impacted by change in ownership or the death or incapacity of a stockholder, employee, or officer. One of the disadvantages of a corporation is that ownership and management are separated. So management makes the daily decisions. The shareholders are not able to participate in those daily decisions. Corporations are subjected to multiple government regulations, and if you look at the illustration, there are some examples. State laws, the SEC regulations, stock exchange requirements, and the stock exchange requirements and the SEC regulations are related, and federal regulations and the SEC regulations and the stock exchange requirements are federal regulations, but you also have federal regulations related to particular industries, and of course you also have the tax laws. Corporations pay income taxes as a separate legal entity, and in addition, stockholders pay taxes on cash dividends. So what this is saying is that the corporation pays dividends on after-tax earnings. So they pay income taxes on the dividends they're going to distribute. The recipients of the dividends, the shareholders, must also pay taxes on those dividends so that the government is able to double dip on the taxation of those dividends. So now we consider, how do we form a corporation? First thing is an application has to be filed with the Secretary of State. In other words, the state in which the organization wants to incorporate. Once the application has been approved, the state will grant a charter, and then the corporation must develop bylaws. And companies will generally incorporate in the state whose laws are favorable to the corporate form of business, and they mentioned Delaware and New Jersey, and one of those favorable conditions would be taxation. Corporations who engage or that engage in interstate commerce must obtain a license from each state in which they do business. Going to consider stockholder rights. First of all, the common shareholders have the right to vote in the election of board of directors and on actions that require stockholder approval. Common shareholders also have the right to share in the corporate earnings through the receipt of dividends. And the final right, which some corporations have eliminated, is to keep the same percentage ownership when new shares of stock are issued, and this is called the preemptive right. What we're going to be doing is we're going to be going through several slides where there is terminology. So the first one is authorized stock. So that in the corporate charter there will be the amount of stock that a corporation is authorized to sell. This is a number that the corporation comes up with. It is the maximum number of shares that it will be able to sell. Also, this number is usually reported in the stockholders' equity section of the balance sheet, and there is no journal entry to record the authorization of stock. The issuance of stock. Companies can issue stock directly to investors or indirectly through an investment banking firm, and corporations usually use the services of the investment banking firm. They will come up with the pricing, they will do the filing with the SEC, and they will underwrite the issuance of the stock. So in other words, they'll come up with that price, and they will guarantee to the issuing firm the amount that the corporation will receive from the issuance. There is a list of factors that are looked at in establishing price for a new issue of stock. First one is the company's anticipated earnings. Next one is the expected dividend rate per share, the current financial position of the company, the current state of the economy, and I would also say the current state of the market in which this corporation operates, and the current state of the securities market. So, in looking at or considering some factors related to the market price of the stock of publicly held companies is traded on organized exchanges. New York Stock Exchange, NASDAQ. The bulk of corporations' stock is traded on NASDAQ because of the more lenient requirements. If you remember from economics, you would have talked about equilibrium price, and the equilibrium price for a good or service is determined by the interaction of buyers and sellers, and that is also true for establishing the price of stock. Assuming that the market is acting rationally, Prices tend to follow the trend of a company's earnings and dividends. Factors beyond a company's control may cause day-to-day fluctuations in market prices. So going back into the 1980s, when there was an assassination attempt on President Reagan, the stock market went down. In 1986, when the Space Shuttle Challenger crashed, the stock market went down. Obviously, when 9/11 occurred, the stock market went down. We need to make a distinction between par value and no par value stock. At one time, the par value was typically required of corporations. So years ago, par value determined the legal capital per share that a company would have to retain in the business for the protection of corporate creditors. And as the second bullet indicates, many states no longer require par value, and that no par value stock is more the norm today. However, in states that do not require par value, the board of directors of a corporation may come up with a stated value instead. Corporate capital is divided into two major categories. One is paid-in capital. That is the amount of money that investors pay into the corporation. So it's the investors that provide the capital funds. The other source is retained earnings, and retained earnings would be all of the undistributed earnings from prior accounting periods. Distributions would be dividends. And over time, of course, we would want to see the balance in retained earnings continue to increase. Here's an illustration of a partial balance sheet, and this is very basic. You see paid-in capital and retained earnings with total stockholders' equity. We have T accounts here. We didn't talk about the sole proprietorship really, but with the sole proprietorship, their equity account is called owner's capital, and the normal balance is a credit. For a corporation, for paid-in capital like common stock, the normal balance is a credit, and retained earnings, the normal balance is also a credit. So, we now have to consider accounting for common stock. We have to identify the specific sources of paid-in capital, and we also have to maintain the distinction between paid-in capital and retained earnings. Some other things that we're going to look at are other than consideration received. So what that means is, instead of receiving cash for issuance of stock, that there may be a receipt of services or assets. And then we also have to remember that issuance of common stock affects only paid-in capital accounts. So we have an illustration here. Assume that Hydroslide issues 1,000 shares of $1 par value common stock. Prepare Hydro's journal entry if 100 shares are issued for $1 per share, or B, 1,000 shares are issued for $5 per share. So we've said that the par value is $1 per share. In the first illustration, the market value and the par value are the same. So we're going to debit cash and credit common stock for $1,000. However, in the next illustration, par value is still $1, but now the price is $5 per share. So if we take the $5 and subtract the par of $1, we have additional paid-in capital per share of $4. So this time we're going to take the $5 and multiply by 1,000 shares. So we're going to debit cash for $5,000. We're going to credit common stock for 1,000. So we're taking the 1,000 shares and multiplying by $1 per share. And the excess of the issuance price over par will be credited to paid-in capital in excess of par. And now once again we have another illustration of the stockholders' equity section of the balance sheet. So we're building on this. So now we have under paid in capital common stock, and then paid in capital in excess of par. Next illustration. Assume that instead of $1 par value stock, Hydroslide has a stated value of $5, and it's no par stock, and the company issues 5,000 shares at $8 per share. So they're going to get $40,000. So we're going to debit cash for $40,000. We're going to credit common stock for the stated value. So we'll take the $5 per share stated value, multiply by 5,000 shares, and that gives us $25,000. The difference will be credited to paid in capital in excess of stated value. So now what happens when no par stock does not have a stated value? What will happen is the entire amount will be credited to common stock, and that $40,000 will be considered legal capital. So that $40,000 would have to be retained for protection of the creditors. So we need to consider some other situations. So issuance of common stock for services or non-cash assets. So corporations may issue stock for services. So for attorney services, consultants, accountants, or for non-cash assets, land, buildings, equipment. The cost is either the fair market value of the consideration given up or the fair market value of the consideration received, which is more clearly determinable. So the fair market value of the consideration given up would be the fair market value of the services or the non-cash assets. The fair market value of the consideration received, which would be the market value of the stock. So here's an example. Attorneys have helped Jordan Company Incorporate. They have billed the company $5,000 for their services. They agree to accept 4,000 shares of $1 par value common stock in payment of their bill. At the time of the exchange, there is no established market price for the stock. So what's going to determine the value of this transaction is the amount that the attorneys billed to Jordan, which is $5,000. So we're going to debit organization expense for $5,000, credit common stock for the par value of $4,000, and then credit paid in capital in excess of par for the difference of $1,000. Now we have an example where stock is being exchanged for a non-cash asset, in this case land. Athletic Research Inc. is an existing publicly held corporation. Its par value stock is actively traded at $8 per share. The company issues 10,000 shares of common stock to acquire land recently advertised for sale at $9,000. So we can determine here the market price of the stock, but not of the land. The land is only advertised at $90,000. The only way we can determine the true market value of that land is through a sale. So if we take the $8 market value for the stock and multiply by the 10,000 shares, we get $80,000. So we're going to debit land for $80,000. The par value of the stock is $5 per share. So now we're going to take the $5 per share and multiply by the 10,000 shares. So we're going to credit common stock for $50,000 and credit paid in capital in excess of par for $30,000. We're now going to consider preferred stock. So preferred stock have priority over common in terms of payment of dividends and distribution of assets in the event of the liquidation of the corporation. They do not have voting rights. accounting for preferred stock at issuance is similar to that of the accounting for common stock. So we have an example. Stein Corporation issues 10,000 shares of $10 par value preferred stock for $12 per share. The journal entry to record the issuance is. So we debit cash for $120,000. So we're taking the 10,000 shares and multiplying by $12,000 per share. We credit preferred stock for the par value. So we're taking the 10,000 shares and multiplying by the par value per share of $10. So we have a credit to preferred stock of $100,000, and the excess is credited to paid-in capital in excess of par, and it should say preferred stock. So when we have paid-in capital in excess of par, we need to have a separate account for preferred stock and also a separate account for common stock. Preferred stock may also have a par value or no par value. Now we need to consider treasury stock. Treasury stock is common stock that had been initially issued but is now bought back by the corporation with the intention of reissuing it in the future. So if you look at this flow chart, if you look at treasury stock, it says less treasury stock account. What that means is that the cost basis in that treasury stock account will reduce total stockholders' equity. So once again, treasury stock is a corporation's own stock that it has required from the stock shareholders but not retired. And what but not retired means is they plan on reissuing it in the future. So what are the reasons that corporations would buy back their own stock? So one is to reissue the shares to officers and employees under bonus and stock compensation plans to enhance the stock's market value. So that goes along with the law of supply and demand. If we reduce the supply by buying back shares, hopefully it will put upward pressure on the price. And then the corporation would reissue shares at that higher price, and their total paid-in capital would increase. The third reason, to have additional shares available for use in the acquisition of other companies. And then the final reason is to increase earnings per share. And the last couple of slides of this lecture goes through an explanation of earnings per share. We're keeping it very basic. For an accounting major, you will go into the discussion of earnings per share in more depth. So, in terms of the purchase of treasury stock, companies will use the cost method. Treasury stock has a normal balance of a debit. It is also considered a contra stockholders' equity account because it reduces stockholders' equity. So if we want to increase the amount in the treasury stock account, we will debit it. And we'll debit it for the price paid to reacquire shares. So we'll debit treasury stock, and of course we would credit cash. So here's an example. On February 1st, 2017, Mead acquires 4,000 shares of its stock at $8 per share. So we're debiting treasury stock for $32,000, and you can see in the parentheses the computation, and crediting cash for $32,000. So let's look and see how that impacts the stockholders' equity section of the balance sheet. We have total paid-in capital plus retained earnings gives us our total paid-in capital and retained earnings of $700,000. We subtract the cost basis of the treasury stock of $32,000, so our total stockholders' equity is reduced to $668,000. As I said, with treasury stock, the idea is that the stock will be reissued again. It may be reissued above cost. It may be reissued below cost. But in any event, the sale will increase total assets and total stockholders' equity. In our first example, the stock is reissued at a price higher than the cost basis. So on July 1st, Meade sells for $10 per share 1,000 shares of its treasury stock previously acquired at $8 per share and makes the following entry. So we're debiting cash for $10,000. We credit treasury stock for the cost basis. So Meade had bought back the stock at $8 per share. So we're taking the $8 per share and multiplying by 1,000 shares. So we're crediting treasury stock for $8,000. The excess is credited to paid-in capital from treasury stock. So what that does is it increases paid-in capital by $2,000. And as the last sentence on this slide indicates, a corporation does not realize a gain or a loss from stock transactions with its own stockholders. So, if they are reselling stock that they had bought back from shareholders, there is no gain or loss. It's either an increase in paid-in capital or a decrease. Students do make the mistake of saying it's a gain or a loss, but it is not. So in the next example, on October 1st, Meade sells an additional 800 shares of treasury stock at $7 per share and makes the following entry. So they had bought the stock back for $8, now they're reissuing at $7, so it's $1 below what they paid for it. So we're going to debit cash for $5,600, so we're taking the 800 shares and multiplying by $7 per share. The cost basis is $8, so we're taking 800 shares and multiplying by $8, so we're crediting treasury stock for $6,400, so the difference gets debited to paid-in capital from treasury stock, and that results in a decrease to the paid-in capital from treasury stock, which you can see in the T accounts. So when there was a buyback, February 1st, we had debited treasury stock for $32,000. Then we had a reissuance of treasury stock, July 1st and October 1st. As a result, the ending balance in treasury stock is a debit of $17,600. As a result of the July 1st transaction, we had credited paid-in capital from treasury stock of $2,000. Then October 1st, we debited that account for $800, so the ending balance is $1,200. On December 1st, assume that Meade sells its remaining 2,200 shares at $7 per share and makes the following entry. We're debiting cash for $15,400. We debit paid-in capital from treasury stock of $1,200, and the reason that we're doing that is that that's all that's left in that account. So we need a $2,200 debit because the sales price is $1 less than the cost. So the other $1,000 has to come from retained earnings. So we're debiting retained earnings and then credit treasury stock for $17,600, which is the cost basis. Right, and the information in this slide is also in your textbook. And you can read through this and think about why Reebok had bought back its shares. So it says here, in a bold and some would say a risky move, Reebok at one time bought back nearly a third of its shares. This repurchase of shares dramatically reduced Reebok's available cash. So you might want to do a web search and see what that was all about, when it happened and why it happened. The last two slides, I'm going to give you basic information about the earnings per share. First of all, The earnings per share is the most widely quoted and relied on ratio by investors. And there was a survey done about 30 years ago, and according to that survey, that earnings per share is considered to be the most important measure of profitability. Publicly held corporations must disclose the earnings per share under net income on the income statement. And if you look at the financial statements for your corporations, you will see that. The earnings per share measures the dollar amount of net income earned by each share of common stock. Future dividend payments and an increase in the value of stock depends on earnings per share, assuming a rational stock market. So basically what we're saying is that there should be a direct relationship between trends in earnings per share and then future dividend payments and an increase in the value of the stock. Now I said assuming a rational stock market. We had already indicated that there are some non-stock related events that would cause a fluctuation in the stock market. So at the time that there was the assassination attempt on Ronald Reagan, and I don't remember exactly what was going on back then economically, it was in 1981, company may have been highly profitable and their EPS might have been increasing, but their stock price may have very well decreased as a result of the assassination attempt on the president. What we have here is a calculation for earnings per share. It's not something that we're going to be doing in this class, but I want you to understand it. And the important thing to remember is we're calculating earnings per common share, not preferred shares. We never do it for preferred stock because the common shares assume the most risk. So there is the greatest potential for increase in market value, but there's also the greatest risk of loss. So this is really a true measure of profitability. A couple more things that I just want to mention that I didn't mention earlier is that common stock is widely traded on the stock market, the secondary stock market. So we as individuals can buy or sell stock on the secondary market. The stock price will tend to fluctuate widely because of the constant exchange of shares. The dividend rate may also fluctuate. So the common shareholders have the greatest potential for gain, but they also have the greatest potential for loss. So therefore they incur the most risk. The preferred shareholders, their dividend is expressed as a dollar amount per share or as a percentage of par value. That dividend rate does not change as long as that preferred stock is outstanding or is available for issue. There is also usually a cumulative feature that is attached to the preferred stock. And what that means is that if a corporation does not declare dividends because they don't have the cash for whatever reason, that any dividends that have not been paid to preferred shareholders in prior years must be paid before the common shareholders can receive any current dividend payments. Also, the preferred stock is typically held by major corporations or other financial institutions that the pool of investors is much smaller than the pool of investors for common stock. Because of that, there is not as much trading of preferred stock on the secondary market, and there is not much of a fluctuation in price. So the primary source of income from preferred stock would be the dividends. Preferred stock usually has a call feature, and what that means is that the issuing corporation can buy back their stock at a predetermined call price, which the investors would know before they purchase the stock, and the investors must sell it back. So the primary reason that a corporation would buy back that stock is so that they wouldn't have to pay those preferred dividends, which do impact the common shareholders. So that concludes our lecture for the first half of Chapter 1. There, as you will see in our module, there's a homework assignment. There is also a quiz for the first half of this chapter. So in the next module, we will look at the second half of this chapter, and hopefully the information that you will get from this module and the next module will help you to really understand stockholders' equity as related to your project.